Just want to make sure I'm not falling off stage. Yeah. Great. Awesome. Well, good evening, everyone. I'm sure a lot of you are here for Blockchain Futurist Conference coming up soon tomorrow. And it's great to be in Miami. I flew in from Dubai just last week, and big RWA is a very big thing in Dubai. I know, Vince, you were just there recently as well. So I'm excited to dive deep into this panel. First off, I'd like to quickly kick off with some introductions. My name is Nikita, as Noel already introduced me. I'm the CEO and founder of Luna PR. We're a PR agency focused on crypto and Web3. We've been around in the space since 2017. Started my crypto career with Huobi Exchange, HTX now, in Singapore. And just now headquartered in Dubai, offices in London and New York, team of 85, and working with several prominent names in the space. Vince, over to you.
Okay, so I'm the CEO of Polymath. Everybody remembers Polymath from a big party that we threw back in 2018. I think it was PolyCon. And it wasn't for polygamy or anything like that, but that was the beginning of this series of tokenizing the global financial system. Since then, what have we done? We've tokenized a lot of assets on Ethereum. We then pivoted and built our own layer one chain, Polymesh. Polymesh was launched back in October of 2021. Now it's been operating. Mainnet's been up and running for about 4 years. And we're an infrastructure play only. We don't carry licenses. We license out all the tech that we build to broker-dealers, RIAs, funds, real estate plays, the gamut. It's out there. And we've got a lot of good announcements that we're trying to do. We're trying to take the company public as well because we wanted to, raise the awareness of what it means to be a layer one chain, raise the confidence level, increase the transparency, increase the fiscal responsibility of what it means to operate a layer one chain as well. I'd say October 10th is not helped actually raising money right now. But anyway, we're going at it.
Don't do it. Matt Nicosia, co-founder of Trust a Smart Chain, taken many companies public and dealt with all of the wonderful ups and downs of the markets. And from that experience, wanted to get into blockchain, did quite a few years ago, and found that there's a lot of issues in that market. So we wanted to bring trust and transparency back to the contract level, build regulatory environment around it, and create a new opportunity and a new way for companies to raise capital instead of being manipulated in the public markets, and do it through the layer one blockchain piece, and also deal with the partners which we have. So very excited to be on, and know Dubai very well. Unfortunately, 3 companies I took NASDAQ had offices in Dubai. Great place. Actually, love Dubai. Phenomenal place, and excited to be here.
And my name is Cade Bergman. I'm coming from Wolf Financial and Wolf Bitcoin. We host some of the biggest spaces in the world talking about all things going on in the industry. CJ actually comes into a lot of our Bitcoin spaces, and this just live shows, very much like radio, but you can call in and participate. So it's kind of like tuning into someone's live stream, and then just next thing you know, you're up on stage. And we've had all sorts of people jump on, and they're a ton of fun. We host spaces on all sorts of stuff. I'm not an expert in the tokenization, digital assets, and especially tokenization and RWAs, but excited for this conversation, and blessed to be here.
Yeah, hi everyone. Chris Sutton, Head of Product of Defense. I've been building in the crypto blockchain space for probably the last decade. MPC infrastructure is kind of what we do at Defense. So we're a technology first, API developer friendly platform. But we kind of cater to the traditional finance players, payment service providers, and tokenization engines.
Hello everybody, CJ Constantinos, as I was introduced. Founder of People's Reserve, and our main focus is on transforming Bitcoin from digital gold to pristine collateral. And we believe digital credit and Bitcoin-powered finance is the future. It is the holy grail that TradFi is seeking right now, that allows for affordable credit and sustainably lower interest rates without anchoring and stating the rate lower.
Fantastic. Everyone comes from incredible backgrounds here. And for the sake of the audience and the panel to kick off, I would like to start off with an explanation on what RealFi actually is and how it differentiates from DeFi.
Okay. All right. Yeah, I can kick it off. So I think the thing when you talk about DeFi is you're talking about a completely permissionless protocol that's being run through smart contracts. So, if you were seeing the big liquidations over the last couple of weeks after the market crashes, permissionless protocols, Uniswap, Aave, they worked without a beat. They didn't fail. Nothing ground to a halt. Markets were open 24/7. Now, as you look at the traditional finance world, as we're moving into real tokenized assets on chain, now you're in a whole different ballgame. You're talking about regulatory environments. You're talking about what are my risk parameters, what are my operational controls, what are my workflows. And within this, you have the human factor, which is the thing that slows everything down. Now, as things begin to migrate on chain, this will completely change into maybe not a DeFi, but you might end up with kind of a permission-like DeFi ecosystem, which hopefully everything moves on chain eventually, right? I think that's why we're all building in this space, is because we see the benefits that DeFi has presented us, and we see the massive opportunity of transferring this into the traditional finance world.
Yeah, it's kind of like a centralized D-finance, right? There's that trusted counterparty component.
Yeah, it's getting there. Like I was on a call today with the Aave team. They've launched. They launched Aave Arc. Back maybe 2020. And I think now they've relaunched it as Aave Horizon. And right now, I think they've locked about 500 million in total value that's been locked. And that is a permissionless lending protocol that is backed by KYC participants. So you're starting to get these things that I don't like, right? Like I don't like KYC, but I understand that that's coming for this ecosystem to become DeFi in a centralized way.
Yeah, I don't mind KYC, AML. I think it makes a lot of sense. But what I do have a disgust for is all of the shitcoinery that's going on right now. Because you have these amazing protocols like Aave and Uniswap, but at the same time you have speculative gambling in a casino with coins that aren't securities, that aren't regulated, that aren't registered, that are worthless. So you have this amazing technology creating an infrastructure for Fugazi. But what this panel is doing is bringing real structured regulated products on chain in a way where institutions and corporations can get access to a new ecosystem, a new credit market, not just backed by proof of promise, but backed by equity like Bitcoin and backed by real businesses who are building I think the future of finance, we would all agree. And that is what is most exciting about the direction that we're heading. We're moving past this stage one testing of crypto games to real private credit markets that bring real structured products that solve real world problems for those who seek yield and seek investments with low risk and high reward.
I still hate KYC.
Just to add on to that, we talk about this a lot in the conversation. I'm usually hosting and learning and taking notes most of the time and letting the experts speak. But with all this new optionality, I guess for me the biggest thing has been now there is the option, and there will be so many options now that people will build these solutions. And it's kind of like this conversation comes up a lot in the Bitcoin spaces, but there will be a time. There's all these stablecoins coming out. I know half my friends are like invested in Singapore dollar. And that's like 30% of their net worth is in there. And I'm like, people just have options now. And if there are good stuff out there actually solving things, I'm kind of with you. There is a lot of tomfoolery and shitcoinery out there as well. That's going to come with it. But for me, the biggest thing is the optionality there. And there are good people doing it right. We had a panel right before this with some really excellent people on the stage. And so for me, it's just exciting to see the options there. And yeah, with the DeFi platforms available, completely trustless. You don't have to worry about it. You don't have to worry about someone closing the accounts. We had the biggest liquidation in the history of crypto a month ago, and half the platforms screwed off. They screwed off, or that's not the right word. They screwed over a lot of their top traders. We saw huge liquidations from people with millions, tens of millions of dollars. They lost their net worth overnight because the platforms had to look out for themselves. And there are plenty of platforms out there that have a self-custody aspect where you can join and trade, but it's in your wallet, and they have limit orders that are going to be set. And so there are some of those options, but I'm just glad to see that they're being built and that there are people being funneled in and can actually get that option now. And I'm a bit torn there on the KYC as well. Like I don't know how I feel about that, so that'll have to be an opinion I maybe have to suspend into the future. I'm not sure yet.
I wanted to just retract to the question on defining what RealFi actually means. And CJ, you said that it's a centralized, decentralized finance, which is interesting. Some may argue that RealFi is based on more tangible, real-world assets on chain. Vince, your layer one is focused on RWAs. How would you define RealFi?
Well, for us, it is identifying. Like my biggest concern is like it's not the scams of like the shitcoin. The shitcoins are always going to be there. There's always going to be somebody actually issuing something. But it's hey, I've got an asset and I'm going to tokenize it, right? So how do you know that you own that asset? And there are examples of like real estate plays, and I think there was like RealT was issuing or issuing security tokens backed by real estate that they didn't own. And I think the city of Detroit is now suing them or something of that nature. So that keeps me awake at night, and that really concerns me because that like anybody can pull that kind of a scheme. For us, and as much as you may hate KYC, would it not make you sleep better at night that you know actually where things are coming from and the source of funds and that your investments are safe? And I would say yes, right? And I think that we try to do things with decentralization, like we're setting up a permissioned, like we were going to set up a decentralized exchange, but it's a permissioned exchange, actually, where everybody's known actually within the ecosystem. So our validators are all financial services entities. The permissioned exchange that's being set up as well is for a particular precious metal that's coming onto the chain as well. And everything is over and somebody was up stage here from Securities as well, is that we think regulatory first, and we seek approvals from the regulators to do what we're doing so that nobody's wearing orange jumpsuits in here, but none of us look good in orange. And we want to make sure that us and our customers actually are following the rules and the guidelines. And so everything is like a checkbox. Does this work? Is that, are the validators all known? Right? And that's actually turning out to be a requirement by regulators that they need to know who all the validators are that are operating in this ecosystem. And there's not too many chains that are out there that are truly permissioned or public permissioned in nature. But it's about doing things actually with the regulator first and then trying to move the needle so that innovation can take off. But they've got to get comfortable with it. Like this whole industry was created actually because we didn't like centralization. And now we're trying to build the trust actually from the other side of the equation actually, and new people are trying to get it. So the early adopters jumped in, it was great. But when there's corrections like October 10th, well, that scares everybody away again. So it's about now building this confidence, and I feel like we're constantly having to prove ourselves. If it's not FTX and it's October 10th, then what's the next thing we're going to watch out for?
And Vince, do you think that that regulation would help situations to prevent situations like what happened on October 10th, 11th?
I don't think so. I think something like that will always happen. Actually, in public markets, that happens. Actually, there's I don't know who follows Fiserv, but they came out with their financial numbers and it was way off, and so they took a haircut. So things like this happen.
This is about the way the market is actually balanced in the protocols. So most people don't understand how a liquidity pool works. So they might end up providing two pairs, like you hop on Uniswap, you throw USDT and USDC together, and you try to figure out, wait a second, why is somebody willing to sell $1 for less than $1 or buy $1 for more than $1? What the hell is going on here? Because it's actually mathematics. So when you talk about market depth and the amount of liquidity that you find in a pool, when somebody comes in to establish a big position or to liquidate a big position, the price of the underlying token is going to move based on a mathematical balance between those two pairings. And there's no way around that. And I think what we are trying to do is we are trying to get to a point where, and this is why I call it CDFI, where not all contracts in the world, we are not moving into a world where you don't get to look the other guy in the eye and shake his hand. Like I see a gentleman right here from Kinesis, they have a C1 stablecoin. And this stablecoin pays 7.5% APY. Well, if that's a random offer in the marketplace, I'm not really feeling too comfortable about it. But because I can go and look him in the eye and shake his hand and understand the dynamics of this regulated and insured token, I'm much more comfortable with the price discovery in the open market. But what we saw happen on October 10th is panic, because there is no comfortable. It's non-KYC, non-AML, wild, wild west. You don't know who you can trust, and if you're the last person holding the bag, you're the last person holding the bag. That's how a multi-billion-dollar coin like Cosmos or Atom drops from trading at multiple dollars to 20 cents within a couple minutes. It's a mathematical formula, and with no backstop built on trust and regulation, that's what happens. Billion-dollar market caps turn into nothing overnight within just a couple of minutes. But when you introduce the trust component, when you can shake somebody's hand and look them in the eye, and when you can understand there are billions of dollars of liquidity backing this ecosystem, all of a sudden you have the comfort to get in and out. You have the comfort to say, you know what? Yeah, this stablecoin is trading at 98 cents momentarily because there's a lot of demand for it. But when that demand subsides, it'll go right back up to where it's supposed to be. It's regulated and it's insured. But in the wild, wild west of Luna and what we saw with these looping mechanisms that is probably causing the crash we're watching right now, all of this unwind with no trust and just a wild, wild west of whoever holds it last loses, that's not how you grow an industry. That's not how you onboard the next billion people. You need a trust component. And even though there are some downfalls to KYC AML, the trust component of knowing who you're working with, knowing the liquidity that is backing the protocol, that goes a long way of making investors signing on the line and putting their money where their mouth is. But in these protocols, what we found out was this. There's billions of dollars backing $1 trillion Bitcoin protocol. And there's probably only a couple $100 million backing $1 trillion altcoin liquidity pool wild, wild west. And it's the influx and security of secured liquidity that is going to build trust in the industry and allow us to innovate and create new products that solve real world problems. But without the trust and without the liquidity, forget about it. You're in the wild, wild west, and you're more worried about earning trust than you are building a solid product.
Back to your question about RealFi, from experience from the years of being involved in building companies and assets from nothing, taking them public and dealing with the point of making something transparent. I see there's a big transition needing to happen, as was said about coins. I'm tokenized this, what's the legal tie to it? For a long time, there was no legal remedy that your token could actually give you an actual claim of ownership to even litigate, with to perfect that claim. Wyoming did a great job allowing you to fractionalize the ownership of the corporations. We've used that heavily in all of our philosophies of, okay, now you can tokenize a shareholder log, therefore you have a claim on an asset. So we view a lot of the methodologies of, okay, we've got a case with multiple case laws that can prove ownership. We'll create entities, we'll create assets, allow them to solicit, file, whether it's a Reg A, an S1, or some type of registration statement, where they're allowed to solicit it and they're allowed to tie it, and also they're accountable. That accountability that can come into place, we believe that there's a lot of those assets, not just in, you would think, companies that want to go public. I've been in the alternative asset sector for a very long time. Alternative assets could be oil and gas wells, they could be any type of real estate investment, things where there's an alternative investment besides the traditional side, but the ability to tokenize that if there is a registration statement in place. We see that as a huge opportunity for tokenization of RealFi. We'll call it making real assets on financial streams. And we think that's something that's going to be, and they're not going to be your very large assets. The majority of them are not going to be your 20, 40, $70 billion funds. It's going to be a guy who's got some supercars that has 12 of them, and he found a way that he can buy more supercars and pay yield on them and let people have a supercar backing an asset, something fun to invest in. Now, it's a fun analogy, but there's real things like that, whether it be boutique hotels, whether they be retirement homes, places where assets where there normally wouldn't be a chance of liquidity through tokenization, if done right, we think that opens up that fractional ownership. And via a proper filing, we use Regulation A+, because I can solicit accredited, non-accredited, domestic, international. Plus, it gives us a long time to actually market the snot out of it, which is very good. Those types of scenarios, I think, are going to help with bringing real assets on chain.
Matt, you talked about fractional ownership. Do you think that the blockchain is very important for fractional ownership right now? It's being done without the blockchain as well. And do you think that every asset needs its own token? How do you see the future of this?
Well, that's a good question. So assets that are, fractional ownership can happen in multiple ways, whether it's a public company, which is fractionally offering its shares, or a company's doing a fractional investment, whether they do through a private placement or other types of offerings. They're offering fractional ownership. On-chain is very important because it's proof of ownership. And a lot of times what happens, unfortunately, in fraud and shitcoins and pieces, there's fraud where things are sold that they don't own and they're oversold that shouldn't be there. So I think on-chain shareholder records is imperative for the growth of fractional ownership as well as tokenization.
That's the big move. The big move. The big move. The big move. The big short. The big long. the Fugazi, small, step up your game. No. So the big move though is the synthetic ownership, right? Like tokenizing stocks. When Larry Fink sits there and says, you don't understand the rate and pace at which this is going to take place, the real power of the technology is that there is a real world contract, a real world enforceable in the court of law ownership. Now, when it comes to stocks, you look at the clearinghouse and you look at who the beneficial owner is, right? And it's the beneficial owner who has the legal right to those shares, but it's the clearinghouse who has custody. And that's what's happening here. We are setting up a system where the clearinghouse is the protocol, but the beneficial owner is the person who owns the token. The critical aspect is that the document, the legally enforceable ownership, is a real document regulated in whatever jurisdiction it's located in, so that ownership can be enforceable. If you look at a token and you say, how do I make sure that I'm the owner of this? Like, what, is this a real thing or is it just a token? Unfortunately, today, the answer to most of the questions is it's Fugazi. But what we're doing is we're taking real world ownership contracts and creating synthetic tokens that represent ownership of these legally enforceable contracts. And that is the difference. That is the difference between RealFi and DeFi. DeFi is wild, wild west, don't get caught holding the bag. RealFi is, this is a real asset, and you, through the court of law, can demonstrate ownership. And you get the added benefits of DeFi through the synthetic token, the 24/7, 365 trading, access to liquidity, all of the benefits that come with tokenization, but tied to a real world contract enforceable in the court of law. That's the real difference.
But so I'm just playing devil's advocate here. So a lot of times retail investors are trading tokens on a speculative basis. They don't have any skin in the game. And companies like Securities, they don't even have a token, a utility token, that is. So how important is a token, a cryptocurrency? The blockchain makes sense completely, but how important is the cryptocurrency token?
I'm going to say it's imperative because, back to your point before, well, you think your clearinghouse has it. 85% of U.S. equities are traded in the dark pool. Run your NOBOs, your OBOs, your DTCs, and your Bloomberg terminals and try to find settlements. I'm sorry to say, it's Fugazi too. Yeah. It is. It's Fugazi. And I've dealt with it on running a NASDAQ company and saying, why? There's 2 million shares in the float. My buddy showed me he's got 1.5. My other buddy got 500. This guy's got my buddies are showing me they've got 4 times the amount of shares that are in the float. It's all Fugazi. It's not to play on it too much. But for the action, to make sure that the asset is not oversold, that is true buying and selling, there does need to be a direct correlation, a per token, per asset, per class of shares, or whatever it might be. Now, a company can have multiple classes of shares, hence multiple tokens. That's a really cool thing which we're doing as well. You can have multiple classes of shares that have different rights and ownerships, but they've got to be limited and finite. That prevents all the fraud that happens in, I hate to say this, custody issues. I mean, you give custody of your stock to your broker dealer who deposits them. You don't own it anymore. They hold it for you. What are they doing? Look at your terms and conditions. I dare anyone here. You have a whole bunch of a NASDAQ stock or whatever, ask them to give it to you in certificate form. Do you know in their terms and conditions that if you say, hey, I want a certificate, they can charge you like an 8% premium? Because they don't have it.
Lots of rehypothecation going on, right?
More than you know, more than any of us know. And we've done a lot of work with some of the forensic accounting behind some of the settlements, like the GameStop issue. It is disgusting, and I hate to say it. Your intermediaries, FINRA and others, participate with it because they want liquid markets. They're okay with it. Who gets hurt? The individual investor and the companies every time. I spend half my time teaching NASDAQ boards how to do shareholder protection because they cannot get it from any agency, NASDAQ, nothing. It is a big issue.
This is I'm sorry. One last thing I'll tap on top of it, because the first real world asset to be successfully tokenized is a dollar. The dollar stablecoins are the first real world assets to be tokenized to prove the use case. What is the use case? Well, would you like to deposit your dollars at the bank account as a bank deposit, a demand deposit that is backed by 10 cents, if you're lucky, maybe by a penny? With the reserve requirements since COVID are still zero. So what's backing that? You're a creditor. So maybe your custodian, you are a creditor to them. And they're doing other things with these shares that you're not aware of in the background to create yield or whatever it is to optimize profits for them. They're putting their profit over your well-being and your custody and your ownership, your guaranteed ownership of what you think you own in your 401k, your IRA, your investment portfolio. And the stablecoin comes out and says, you know what? And especially with Genius, 1-to-1. This is wild stuff. I actually got to talk to Byron Donalds about this. He's my local rep. He sat on the Financial Services Committee. I said, Byron, I know you guys need demand for treasuries. Like, I really know. Trust me, I know you need it. Just look at the yields, right? But have you thought about the fact that with a real world asset like a dollar being tokenized and a legislation like Genius requiring a 1-to-1 backing, have you guys just discussed that you're giving the marketplace an option here, right? The option is demand deposit backed by 10 cents that you have to pay 3 to 5% to take it out of the ATM. And by the way, if you want more than 10 grand, you better ask permission. Mommy and daddy bank don't like you moving too much money at once. Or a stable coin, backed 1-to-1 that you can move 24/7, 365 with nobody's permission but yourself. You're gonna create a crisis that is worse than the interest rate crisis. It's worse than bank demand deposits moving to money market funds to chase yield. They're gonna move out of the bank deposits into the stablecoin for freedom. And you're gonna have bank term funding program version 2 in order to provide the liquidity for all of the people exiting into a more free and fair system where the blockchain itself gives insight to the reserves balance versus the liability balance. Compared to a banking, I mean, what do we gotta wait for the Qs and Ks to come out? And we have to trust them on top of it? That added layer of trust is the main selling point of DeFi. But because it went so wild, wild west, we have to kind of revert back a little bit and enter that centralized, the polymaths and everybody else to come in to shake your hand and say, look, we're regulated and you can hold us accountable. If you think we are breaking this contract, sue us and bring us to court. And we will prove in the court of law through blockchain documentation and through real world contracts that we are in good standing. And that's what the traditional system can't do. It's just, trust me, bro.
Yeah. No, it makes sense. It's very apparent and evident as to why moving real world assets on chain is so important using the blockchain and cryptocurrency. And to date, we have tokenized, I would say, around $8 billion, I think I read earlier today, out of the $900 trillion financial assets in the world. So what is the key to actually unlocking these assets and moving from blockchain to being a niche to the actual infrastructure?
Well, there's a couple ways, and I'll just, if you guys want to jump. To tokenize something, you put a contract with it, smart contract with it. There's different ways to call it tokenized. There's a difference between, I would say, real-world assets tokenized and real-world assets registered. Meaning, is it now registered and transparent so it can have a secondary market? That's a big issue. In order for that to happen, they're going to act as securities, unless you're doing some commodities and some pieces. But the real-world asset companies or projects, they're going to need to start filing registration statements and audits and keep them up to snuff. If not, you're not going to be able to have a secondary market. Tokenized is one thing, but is it registered so there is now the transferability in the secondary markets is a separate question.
But beyond the technicalities, is it education? Is it liquidity? Because RWAs have been it's been the buzzword for the last year, but there's a lack of liquidity in the space. So beyond the technicalities on how to tokenize, how do we actually get people to want to tokenize?
Innovation. That is the 100% answer to the question. Because what we need are solutions to the real world problems that are faced in traditional finance. And you are not getting innovation from your bank. I'm sorry, no offense to any bankers in here, but they are scared of the innovations that are taking place in the free market right now. They really are, because they know they cannot duplicate it, because it's not in their best interest. It turns out that these L1s and these different tokenization platforms are creating products and services that actually solve real world problems. I mean, at People's Reserve, we've created a Bitcoin-powered mortgage. So we call it Bitcoin-powered finance because we have a plethora of products, but our Bitcoin-powered mortgage, we write a mortgage that is secured by the property of the property title as well as the Bitcoin. But then what we do is we take these and we package them together in what we called, and some of you might be a little bit worried by this name because of what happened in 2008, but we call them collateralized Bitcoin financing obligations. Right, so these collateralized debt obligations and these collateralized loan obligations, bad stigma around that because of what happened, because of all the games that were played by these traditional bankers. But what we're doing in the free market is we are creating a brand new product. I believe it happens to be the best risk-adjusted cash flow product in the world, because you are still averaging a 6% APY, but it's secured by, unlike an MBS, which is only secured by the title, it is secured by title and it is secured by Bitcoin, which we call pristine collateral, 24/7, 365 liquid collateral, right? So this hybrid product then creates a new area of yield, a new product that's never been before seen by the world. And you can come in and you can get 6%, not because the central bank stated and anchored the rate, but because that's what the free market is willing to pay. And even at 6%, it's less than the hard money lenders coming in at 10%. If you have gold, look at the way gold is performing right now. Gold is we haven't seen this since the 70s, so something similar must be happening right now, right, for those who are wondering. But if you have gold and you're willing to buy a home, and you say, you know what, not only will I promise to pay you for the next 30 years, I will also post gold as an additional form of collateral. What can you do for me? Can you lower my interest rate? And what about from the LP side? If you're a liquidity provider, what does that do for you to the risk aspect? It's no longer proof of promise. What's amazing is when you integrate sound money into credit, you transform traditional credit's duration risk into a duration benefit. Because over the long term, the volatility of Bitcoin creates risk in the short term, not the long term, because of its compounding annual growth rate, and gold as well. Gold has a CAGR that over the long run, the risk in the loan is reduced. So what happens when you create a new product like this, you redefine the risk-free rate in the marketplace. You redefine the risk-free borrower in the marketplace. And as it stands right now, it's the governments who have the power of the printer who are the risk-free borrowers. But no. Just because you can print the money and give it to us, we don't know what the hell we're going to be able to buy with it. There's inflation risk. There's duration risk. How do we address this problem? We turn duration risk into duration benefit. And these are the types of innovations taking place in CDeFi that the traditional bankers don't want to touch with a 100-foot pole. And in that way, we're going to be able to outcompete them and out-incentivize the customers. So how do we onboard those next people? Through innovation, through new products and services that the traditional bankers would never even take a risk on introducing to the marketplace, and creating new opportunities for both borrowers and lenders with the technology.
I would like to give an opportunity to Chris, Cade, and Vince to also chime in on the topic on how to bridge this gap of bringing real-world assets on-chain, since we've emphasized on the importance of it. And perhaps there's different angles outside of innovation. I think education is a very important angle. Cade, you guys run a fantastic platform to educate such a large audience. Vince, maybe you can shill your amazing PR agency and all the work they've been doing to
That?
but yeah, anything else outside of innovation or the technicalities?
I think actually we just got to get comfortable with being uncomfortable, and I think we are uncomfortable where we are right now. But I think it's the that common saying, you got to crawl before you can walk, before you can run. We're still at that crawling phase. We're still educating the market, right? And when I talk to a lot of institutions about tokenization and what it can do for you, and anybody that's at the head of any of these large institutions, they look at two things, right? How do I increase my revenues? How do I save on my operating costs? And how do I put more profit actually to the bottom line in my pocket, right? If you're not solving or providing something like that to an institution, then you're not solving anything, right? You're not providing them any value whatsoever. So it's about explaining it to them in terms that they can understand. Otherwise, we sound like the squelch of a modem. Does everybody know what a modem is here? Do you know what a modem is? Maybe not. I know you do, and I know you do. But otherwise, it's just squelch. It's just noise that actually we're talking about constantly over and over again. So it's about creating these or educating the market and solving the problem. And we've seen this before where, and I think that in the capital markets industry, when Uber was disrupted, capital markets industry said, ooh, that's really bad. When Airbnb came out, it's like capital markets industry like, ooh, that's really bad too. And it's like, I feel bad for your reporting. But now the capital markets industry is actually, this is the disruption that's in their backyard, in their back pocket. And it's that snow globe that you're shaking, and it's like, you don't know how it's going to land, but it's going to, eventually it's going to fall again. But there's a retransformation of, just like an Uber, right? The taxi drivers and those expensive licenses, well, they're not so expensive anymore, right? And so there's got to be a redistribution of who does what in this industry. Transfer agents, are they really needed in this industry? Probably not, because it just settles on chain instantaneously, right? You don't need them, right? So I think it's a matter of looking actually at just how the capital markets works today, innovate actually as far as what your job is doing today, and maybe it's not going to be doing it tomorrow and you'll be delivering the mail. Oh wait, that's email right now. So maybe you won't be doing that either. But there's something, it's that retransformation. And I think we just got to think through that retransformation again. Technology solves problems. Blockchain wasn't created actually because, hey, this is such a great idea. Putting, like the title insurance actually, or land titles actually on blockchain, that's a great idea. Putting like other things on the chain is a great idea. You could tokenize it that much faster. And Dubai's done that instantaneously. All land titles are on a blockchain. Therefore, they can be tokenized in 24 hours, right? We don't need an SPV in Wyoming in order to do that, right? So you remove an entire, and you know who hurts in all this? Title insurers, lawyers. I don't know how many lawyers are in the room, but sorry. But like there's like again, there's a minimization of tasks, but we're running more efficiently. But we can all make more money running efficiently.
I like to always look at like when I was talking to banks like 5 years ago, it was always like a fringe topic. It was like the innovation team within a bank, and it was like a couple of guys, and they wanted to do something in the blockchain space. They didn't know what they wanted to do, but they wanted to do something. It was exciting to them, but it didn't really extend beyond those couple of folks in the innovation team. Now every top tier US bank has a dedicated digital assets and blockchain team, and they're all like really focused now on how do they start to actually offer these products? How do they bring blockchain internally into the operations of the bank or an institution? And they're all very familiar with like securing private keys, right? They work with HSMs, they work with hardware security modules. They've been doing this for basic encryption tasks for the last 30 to 40 years. But the piece that they are now moving into is how do they actually interact with the blockchain? Like blockchains are difficult. They're not easy. Anyone who says blockchains are easy, even to deal with data, have never integrated a blockchain before. You have to index the blockchain. You're working across different finality rates. You're trying to get confirmations. You're constantly upgrading the data that you have, and that's really the next piece: is how do we provide the building blocks for institutions to switch that on from an infrastructure perspective. So like last week, we announced at Defense, like IBM is white labeling a custody solution. So you have someone like IBM who's, probably to a lot of folks is a dinosaur of the past, but you have 70% of the world's financial transactions still going through IBM hardware. And that's something that financial institutions can now leverage as part of their existing IBM relationship. They can flip that on and start integrating and interacting with blockchain technology. So this is like the start of that initial movement of how do we start switching institutions on, whether it's banks, whether it's people like Swift, MasterCard, Visa, they're all eventually going to have these rails in-house.
And Chris, I'd like to elaborate on that point a little bit more. How do you envision in the next 5 years for these rails to look like? Right now, I believe most RWAs are functioning on ERC 1400. Is it? I'm not too familiar.
Ask the Polymath guys. They open sourced it.
Some of that out there.
Something like that, and there's so many different blockchains doing this. Will they all be interoperable? Is there going to be one unified chain that dominates? How do you envision this?
It's very much going to be a multi-chain world. You're going to see assets on multiple different chains, similar to what we see in the stablecoin space. There isn't a clear winner in terms of what is going to be the chain for tokenized assets. I think that there is going to be a lot of elements around privacy-preserving technology, especially in the capital market space, and that's where I think maybe completely non-public, transparent chains are probably not the best use case for some of those sensitive asset operations. So that's where I think guys like Polymath, Canton Network, Zama are always going to be able to provide that extra layer of privacy for their customers. So very much a multi-chain world. It's great for institutions, terrible for infrastructure providers because we have to support all of them.
Would you say that a blockchain is a crappier, more expensive version of an Excel or Google sheet?
Well, I think that's also the thing is there was like a big movement maybe 3-4 years ago where everyone was just trying to put everything on a blockchain. You don't need to put everything on a blockchain, right? If you look at the original, why do you need a blockchain? It's because you need decentralized consensus. That is the one benefit of having a blockchain. If you do not need decentralized consensus, you can probably get by with a high-performance database, right? That's the reality of things.
Trust, right? It comes back to the trust element.
Right, yeah.
So let's ask the audience a question. Do you trust the government more yesterday or today? Yeah, see? There you go.
It's shut down. It doesn't exist anymore.
Right. Yeah. We're in a better spot, by the way, right? If you haven't noticed. But blockchain, the reason that you pay more to establish a blockchain and deal with the intricacies of integrating blockchain is trust, right? So really, this is a signal of where our world is heading. Our world is getting to the point where all governments, global debt is over $300 trillion. All governments have abused our trust. And therefore, businesses need to cut the bottom line. Like, we'd love to see them increase the bottom line, and I think they will, because there's certain ways it becomes more efficient. But ultimately, it's less efficient, but with that lower efficiency comes higher trust. And that is the trade-off. The trade-off is, hey, with blockchain, why not just use our Excel spreadsheet? Why not just use our Google Sheet and just trust our accounting and trust our entries? Well, because we can't trust you anymore. Because you've abused it to the point where we have now lost so much purchasing power in our currency, regardless of what country you're from, that we cannot trust you to do this anymore. So the real trade-off to moving to blockchain is reestablishing trust. Getting, JP Morgan, Citibank, Morgan Stanley, BlackRock, all the big dogs, whether they were guilty of abusing that trust or not, they are a victim of a lack of trust within the marketplace because of deficit spending of all governments globally. And this movement that we see here is the epitome. It is the result of abuse of trust. And establishing the blockchain to get rid of trusting your counterparties is really what's happening here. And I think that's the bigger overall, like, 30,000-foot view, where it's like, wow, people have actually been pushed to the extent where you can tell me CPI is 2%, but anybody in this room will know your prices have gone up more than 2%. That's bullshit. So what's really happening is, I don't trust you anymore. I don't trust your data. I don't trust your proof of ownership records. I might not even trust your courts. So therefore, let's put this on chain. Let's use the blockchain, and you know what? We'll take a little bit of a hit through integration costs and through the complexities of putting this into our system. But what do we gain? We gain back that trust. And that's the most interesting element, I think.
To add on to that really quick, I agree with you. We have all sorts of these conversations all the time about the trust factor there. And going back a little bit, there was saw a couple weeks ago, Amazon cut a ton of jobs, tens of thousands of jobs. And in terms of what's going to end up being, what ends up mattering in the marketplace, what ends up being the highest ROI skill, the things that can get you the jobs, the things that can get you elevated and give you an edge in this market, whether it's in the jobs or whatever your expertise is. I don't know what those are going to be. It's kind of hard to answer that question. I would normally defer to the experts for it, who are deeper in the RWA field in particular, because I'm not an expert in those fields. But I imagine like half of those solutions will be things we can't know yet because of the most broad topic of all time, which is just AI. It's just such a black hole of we don't know what's going to happen, and we don't know what kind of solutions and jobs will be needed. But I agree with CJ there was you have to build, this is something he said earlier, you have to build solutions. And right now we have a lot of potential solutions, maybe more in theory than anything else. Like there was so these ideas, you could tokenize this, you could tokenize a hotel. It's like, okay, is that something we need? Is there a demand for that right now? There might be in the future. And so it's really hard because an idea like Airbnb at the wrong time doesn't hit, but Airbnb at the right time absolutely explodes. And so it's very hard to predict these things. So typically I'm just deferring to the experts in particular in this tokenization world. But this is a fascinating topic. I agree with you. The 30,000-foot view and the conversation really is about that trust factor.
CJ, very well said on the trust aspect. Recently, and I think that the same gets reflected into the crypto world, right? So recently there was a project actually called RealFi that was built on XRP and claimed to tokenize over $600 billion of global real estate.
You could just stop right there at XRP. That's all you need to do.
My question was, how do we differentiate between actually what's in the reserves, proof of reserves, and marketing puffery?
Yeah, I mean, that's where you really have to find a trusted counterparty. And that's where it comes to looking the person in the eye and shaking their hand. So I believe, Jai was up here from Kinesis Monetary on the previous panel. These guys have C1 USD. It's a brand new stablecoin. It pays 7.5%. But you don't just have to trust them on that. This is an audited, insured stablecoin that gives you access to DeFi. And through DPI Capital, Shahan and Brent and those guys, let me tell you, as somebody who's been a DeFi market maker for over 8 years, they may have forgotten more about DeFi than I even know and understand. So the fact that you can meet with them, you can shake their hand, you can understand their contracts, you can understand the strategy, this is important. Bitcoin dropped below $100,000 today. In my opinion, the reason that that happened is because of this looping strategy we saw in DeFi. So you have you have hypothecation, rehypothecation, looping hypothecation, double looping hypothecation, and before you know it, you're playing the same exact game as the guys who are holding our stocks pretending that we have beneficial ownership, but really we're creditors. So you have the big players in the game leveraging a technology that is supposed to empower we the people. The whole idea of blockchain technology and decentralized finance is not to extract value from people. That's what the traditional bankers do. We are here to deliver value to you. That's our mission. And that is the key difference. So when you get into a situation where you see the opportunity to get into this token or to get into that, do a little bit more due diligence. Make sure they're registered. Set up a call, set up a meeting. You're going to be able to get in touch with somebody. You're going to be able to look in the eyes and shake hands. That's how man does business. We've done business that way for thousands of years. That's not changing, even with AI. I don't care what anybody says. I am not moving any amount of money with an AI bot. Forget that. I trust the AI less than I trust the bankers. And that's really saying something because we're already in negative territory with that trust. So the ability to look somebody in the eye, understand the protocols, have a real world contract that is regulated and can be audited and is enforceable in the court of law, that's RealFi. DeFi says, don't worry about that, bro. We're looping, we're leveraging, 100x, let's go. All these crazy things. If it sounds too good to be true, it is too good to be true. And even sometimes 7.5% can sound a little bit too good to be true. So you know what? Do your due diligence. Understand the system. Understand where the yield is coming from. Because if you don't know where the yield is coming from, I got bad news for you. You are the yield. But in the world that we're moving into, you can actually understand these things. And you can actually benefit from the yield. And that's where the next billion people come from. The next billion people come from the people who realize, you know what? When we invest in this protocol, when we invest in this ecosystem, we can actually get positive real rates of return. Forget about the US government telling me that I can get 4% because that's what they state the federal funds rate. Well, guess what? It doesn't matter when you get 4% when inflation is 5, 6, 7, 8, 9, and 10%. The rate of return you're getting is negative in real terms. So forget about the nominal value. Focus in real value. What's real value? In terms of purchasing power. And when you start solving those problems in a way that is fully regulated, in a way that is documented, and in a way that, most importantly, is enforceable in the court of law, that's when people start moving their money. And that's when this system will take off. And that's when you'll see billions of dollars flow in to stay, not to run out when they get scared with the volatility.
Amazing. So we have just one last question, and it entails a one-word answer. If there was one thing that you could change about today's infrastructure to make RealFi actually take off in one word, what would that be?
Innovation.
I'm thinking. There's lots of words. Come back to me.
We'll come back to you. Okay.
Man, that's tough. Maybe timing, maybe, for a business side.
How to put it in one word.
That's the word.
Fugaz, yeah, funkuna. It's going to be a mishmash of words because I'm going to make two words into one word. Clear regulatory. Clear regulatory. Clear regulation.
I'll end how it started, innovation.
Flexibility.
Amazing. Thank you so much, everyone. Hope you guys enjoyed the panel.